Good morning and welcome to the first ever Real Estate Chicas talk show. I'm Jen Olmstead and with me is my co-host Anna. We are both here with Olmstead Real Estate Group and we have a special guest today, Anna Urban, who is from Fairway Mortgage. And today we are going to be talking about first-time homebuyers and the FHA loan. So if you have any questions, you can put it in the comments and we will be sure to answer it as we see them. So today, let's talk about first-time homebuyers, the pros and cons of FHA loans, and what you can expect when you're applying for a loan for the first time. Anna.
Hi, everyone. Sorry, trying to warm up here the gears. Well, my name is Ana. Thank you for, I'm so excited to be here too. I speak Spanish, so I just wanted to throw out there. I mean, I'm sure you noticed that with my accent, so just remarking that. And yeah, well, we'll talk about the first-time home buyers owner, and I think I don't know.
Well, let's go ahead and get started.
Yeah.
Anne is from Fairway Mortgage, and she has been a lender in the industry for a while. So, Anne, why don't you go ahead and tell us a little bit about yourself, and we'll get started with talking about knowing your budget.
Yeah, thanks for having me first. This is super exciting. But my name is Ann Urban. I'm a residential mortgage lender with Fairway Independent Mortgage Company, or Corporation, excuse me. And I've been doing this for about 8 years now. Started as a paralegal, working for bank counsel, then did processing and closing, and then kind of got back into my customer service salesy side and went back to originations, where I've been for many, many years now. But knowing your budget is super, super important when you're going to shop for a house. There's nothing worse on this planet than finding your dream home and then finding out that it's out of your financial reach. So, it's super important on the front end to talk with a mortgage lender, find out what your monthly payment might look like, find out what your final cash to close figure might look like, so that you know whether you're shopping in that right price point. I can tell somebody they qualify for something. I always tell people, how much you want to go buy coffee, go to the movies, go on vacation, things like that. Your real world budget. And if you don't have somebody showing you your options and showing you how you can get there, you can get into a pickle and end up disappointed. And we don't want that.
Absolutely. And knowing your household budget is really important when we're trying to figure out what it is that you're trying to achieve in terms of price point. So knowing how much you would like to spend, what you spend currently on your rent is going to be a great indicator of what you can afford in a mortgage. And, at that point, then we can kind of build off of location and things like that and where we're going to end up, looking for the home search. But starting with the loan officer is really where you want to go. If you haven't been pre-approved for a loan yet, you're going to want to talk to a lender because they're going to let you know all of that based on your budget.
I will add, like, in knowing your budget too is important to know your values. Like, let's say if you have a, I don't know, big family and they come every week, well, maybe social spaces will be a feature that you want to look for. Or if you like gardening, maybe it's the backyard. So how can you study the features of the house as well? So knowing all that information, it will make the process less overwhelming and really find the place that you like and feel comfortable, which is your first home.
Right. And I also think it's important too, because a lot of people don't realize that your taxes in a lot of these loans, especially FHA, are escrowed in. So if you're using a mortgage calculator online and it says that your mortgage is only going to be $700 or maybe $800, that may not actually be accurate because your taxes will be escrowed in. And that will be a huge portion of what your monthly payment will be, which will impact your budget.
Right. 110%.
Yep. So, Anne, why don't you explain the difference between being pre-qualified and pre-approved?
Yeah. So the biggest thing between being pre-qualified and pre-approved, and understand that a lot of this is terminology that a lot of lenders will use interchangeably, and sometimes they use them to mean the same thing. So in the most basic of terms, a pre-qualification or a pre-approval is a form of mortgage approval. It depends on if you're, most pre-qualifications are based off of basic information. Somebody might just fill out an application, give a verbal on their income, things like that. So you do have to be a little bit careful. Not all lenders are created equal. A pre-qualification from one lender is maybe more, have more weight and more validity than a pre-approval from another lender. Pre-approval in its most official terms means it's been submitted through underwriting for a review. It means an underwriter's laid their eyes on your income and your assets. You've most likely had to provide that verification documentation. Sometimes, though, the pre-approval is pretty weak. Sometimes they say subject to verification of certain employment verifications. And so that's why I say some pre-qualifications from a lot of lenders may actually have more weight and more clout than a pre-approval. So you do have to be a little bit careful there. Pre-approvals may take a little bit more time because they have to be submitted through underwriting. I actually have access to something, so if for something is a red flag, or I have some concerns about somebody's employment or how they're being paid their variable income, I have an access to a scenario. It's called a scenario review. So instead of it being a full underwrite, I don't have to have that wait time. I can submit it, and someone can take a look at what I'm specifically concerned about and let me know if they think we're going to be okay. So that's kind of the most basic difference between the two. If you want to show, sometimes the pre-approval will show a little bit more validity to a seller. But again, I caution people that sometimes the pre-qualification is better from one lender than a pre-approval from another. So just if someone's not asking you the right questions, and a lot of times with the online lenders, you're not actually having to submit all of your information, understand that your approval from that lender may be weak.
One thing that I can't stress enough is right now, due to low inventory, we are still in multiple offer situations. So having whether it's a pre-approval or a pre-qual, having it fine-tuned and basically ready to go prior to making an offer is extremely important in this market, because the listing agents are calling each and every one of the banks and making sure that the buyers who are involved in these multiple offer situations are in fact good to go, because they can only choose one offer. And if that offer happens to be with a sloppy pre-qual, it could really impact the whole sale down the road after being off of the market for 4 to 6 weeks. And sometimes I've had people have really bad mess ups where the loan officer did not properly pre-qualify or pre-approve the buyer. And we were days before closing and something was found that actually made it so the buyer did not qualify. So making sure that your pre-approval or your pre-qual is good to go and doing everything that you can as a buyer on the front end will make it so much easier when you do find the house that you want to make an offer on, because chances are you're not the only buyer who wants to make an offer on that house. So I can't stress enough making sure that you are pre-approved or pre-qualified by a lender. I have worked with Anne on pre-approve or pre-quals, because you do pre-qualifications, but yours are solid. So
yeah. So like I said, again, I know what those red flags are, and if I have concerns, then I'm going to dig deeper. And specifically, if someone is self-employed, I need your tax returns. There's no way, if you're self-employed and your lender didn't ask for your tax returns, your approval is not valid. There's just really no way to evaluate that. So I ask for things up front, and so usually I'll put in my pre-qualification as well what documents I have personally reviewed to indicate that they qualify. And certainly, like I said, they're calling lenders. And so sometimes we end up having to get on the phone and vouch for these people. And so, I care about my reputation, and I care about my clients, and I care about your reputation and all the agents that I work with. So I'm not going to put something out there that I can't put my name behind.
And a good question for the self-employed and independent contractors: how long do you have to be in that industry before they will allow you to get a mortgage? Or how long? 2 years. So you have to show 2 years of tax returns as an independent contractor. And does it have to be positive revenue on both of those years?
Yeah. So what happens is if somebody has a loss in the most current year versus, to perceived income that's declining, the average is going to be based off of the year that's worse. So just to be conservative, you want to, in general, see positive rising income. Obviously, with COVID and things like that, some businesses didn't see that, but we have to be very, very careful when we're looking at the tax returns right now because of things like that. that it looks like their income is going to continue, that their business has liquidity, things like that. So it is very, very important. The only kind of exception to the 2-year rule is if someone's been in that line of work and has been in that business for 5 years or more, sometimes we can get 1-year findings. So normally we're going to average that over 2 months unless the income is declining, in which case it will be averaged over your most recent year.
Okay, great. And is the FHA loan an option for independent contractors?
It is. Yep. So it's not, the type of income does not change, whether or not you can go conventional or FHA.
Okay, great.
How long does it take to get your pre-qualified?
Yeah, very good question. So generally they can be turned around in the same day. It just kind of depends on what time of day you apply, what type of complexities you have, if you own other properties, if you're self-employed. Self-employed can sometimes take a little bit longer, especially because, again, I'm dependent on getting those tax returns for review. And if you own those other properties, then we need to do a little bit more of a deeper dive on those properties, whether they're income producing, if you've got positive rental income, that kind of thing. But in most cases, can be turned around in 24 hours or less.
Okay, that's pretty
great.
Good.
So what's the percentage down? So if we're doing an FHA loan, the percentage down, how much does somebody need in order to qualify for this loan?
Yeah. So for FHA in particular, the minimum down is 3.5%. So if you're looking at kind of conventional versus FHA, there are first-time home buyer programs that will allow you to do as little as 3% down conventional. If for some reason you didn't qualify for one of those programs, then you'd be looking at 5% down minimum conventional. But FHA is 3.5%.
So I want to talk about the pros and cons of the different types of loans, FHA versus conventional, and kind of transitioned into that. So right now, like I mentioned before, a lot of these homes are in multiple offer situations. Because the FHA loan tends to only be 3.5% down, and it is a government loan that requires some more, more stipulations like you can't have any chipping paint. You have to have handrails. There's certain things that the appraisers go out and look for, and they will flag on a house if a buyer is an FHA loan. So when you are in a multiple offer situation, if you are making an offer, it could be a very strong offer, but your loan is an FHA loan, there is a very good chance you're going to be low man on the totem pole, just because that loan does come with some higher stakes for the seller. So as Ann mentioned, what we try to do is we try to look at all of the options, FHA versus conventional. A conventional loan does not have those same guidelines that FHA carries. So if we can get you into a 3% conventional, we'll do that because your offer will carry a little bit more weight. But in terms of the borrower, what do they usually need to have in order to qualify for a conventional versus FHA? Like, what are you finding that most buyers are doing FHA? Why are they doing FHA?
Yeah. So just in a nutshell, FHA loans, they allow lower credit scores. So for those folks who may have a credit score, like currently, I can do a 580 for an FHA loan. Conventional is sitting at a 620. So if you do have some things, maybe you went through a divorce, maybe you had some medical issues, whatever, and you've got some blemishes on your credit, that might be one of the reasons we go FHA. If you've had some sort of a foreclosure action, something like that, the rules for whether or not you can get a mortgage for FHA or conventional, those would also change. So those things kind of dictate. There are more rigid property standards, like you said, in the FHA loan, the peeling paint, missing handrails, any sort of safety hazard issues, things like that could become a hiccup if you went FHA. There is there's private mortgage insurance that's required for conventional mortgages if you do less than 20% down. FHA has a monthly premium and an upfront premium, and that monthly premium does not change or is not dictated by your credit score like it would be conventional. Conventional has the option to allow you to remove that PMI though, whereas on FHA, it's kind of there for life. So, when I'm looking at somebody for a pre-qualification, especially right now with the market being as competitive, like you said, FHA is probably going to be the low man offer on a totem pole, but for some folks, that's how they're going to get a mortgage, or it's the best way for them to get a mortgage. So we're going to look at all of those comparisons to see what makes the most sense.
Great.
are the closing costs that the same in FHA loans and conventional, or do they change?
I'm sorry, what was that? I didn't hear you.
The closing costs, are they the same in the FHA loans and conventional, or is there any changes? Do they change?
Yes, good question. Yeah, so with the exception of the fact that you're going to have upfront MI on an FHA loan, but that's allowed to be financed. Okay, so you can finance that into your loan amount. The closing costs are going to be typically about the same. Your FHA appraisal may cost a little bit more than your conventional appraisal, just because it has to be someone who's HUD certified to go out and do that. But other than that, for the most part, your closing costs are going to be very similar.
Great. And would you describe as well what are the closing costs, and can you walk us more through? Because I think as a first-time home buyer, sometimes you don't consider that, and we don't think about that, and that's a number that we want to keep in our budget as well.
Right.
Would you mind sharing with us what's the process?
A lot of buyers are thinking down payment. They're not realizing that it's down payment plus closing costs at the closing table. So they're thinking, oh, I need my 3.5% down, not realizing that there is actually another number that you have to come with. And why don't you talk to us a little bit about that and how FHA loans can include the closing costs?
Yeah, so I'm really glad that you brought this up, because it hasn't come up recently. And it does come up fairly frequently. People think that the deposit that they put down on their contract is like their down payment on their loan, and they think that that's it. And that's not the case. Your deposit that you put down on contract really has nothing to do with your actual down payment on your loan. Mm-hmm. And the deposit that you put down on contract is, in good faith that you're buying this, you want to buy this property. But your down payment for your loan is going to either be that 3.5% if you go FHA, or you can actually do more. You can do 5% down, but the minimum is 3.5%, plus your closing costs. And closing costs are going to be things like your appraisal, your title work, a settlement agent for closing, your prepaid, so anything to do with your homeowner's insurance and taxes. So like Jen mentioned before, your taxes can become a super important piece, not only to your monthly payment, but also your closing costs for your initial deposit into your escrow account. So on average, what does that all mean? It means usually closing costs are about 3 to 6% of your overall purchase price for your home. So for example, if you purchased a $200,000 house, you're going to be looking in the spectrum of anywhere from $6,000 to $12,000. I would say on average, New York State is probably going to be on the higher end of that. You do have taxes you have to pay to the state as well. If you go FHA, you can incorporate something called a seller concession, or if you go conventional, you can do it as well. But we have a little bit more room as far as how much we can factor into a seller concession on an FHA loan. So we can go up to 6% on an FHA. On conventional, we can go up to 3%. So this is kind of a fancy way of kind of saying your seller helps you kind of finance and pay for the closing costs at closing, helps mitigate that cash to close figure. So you're going to have two things. You're going to have your down payment, and then you're going to have your cash to close. And your cash to close is your down payment, all of your closing costs, less your deposit, any seller credits, or if you're getting any lender credits as well. So that becomes your bottom line of what you owe at closing.
Great. So keep that in mind. And a lot of times that anywhere from $6,000 to $10,000, really depending on what the taxes is additional to your down payment. So closing costs and having those wrapped in as a seller concession can really help, because putting that in over 30 years and having it be a part of your loan is way better than coming to the table and pulling that out of your pocket or out of your assets. If you can keep that and actually just have it rolled in, the interest that you're paying or the add-on to your loan is so minimal that it's not going to impact your monthly payment, versus all of a sudden now you're out $10,000, and let's just say in the next 5 years, your roof or your furnace or something along those lines, where if you had that in your savings goes, it could be a real issue. So definitely, if right now our market, though, it's a little bit more difficult to have seller concessions if there's multiple offers. As we're watching it change and shift, you will find that having a seller concessions towards your closing costs will actually start being more of the norm again. A few years back, you would see it across the board. Conventional, like you were mentioning, conventional, FHA, VA loans, USDA, all of them would have some sort of a seller concession. And, it was really nice and easy and great for the buyer and worked out really well. So you will see that come back into our market here pretty soon. But what's important to know is that homeownership is a lot easier than you think. A lot of people think that they should just continue renting and they're paying $1,600, $1,700 a month, which is actually a pretty sizable mortgage. So if you're renting, you're tired of renting, thinking about buying, but thinking that maybe your credit score is too low, as Ann had mentioned earlier, she can get an FHA loan approved with a 580 credit score. So it doesn't hurt to just reach out to one of us and see what you qualify for, because even if you don't qualify right now, Ann, do you usually help people point them in the right direction of what they need to do?
Yeah. So, if there's some kind of minor credit issues, then there's things that I can do on my end to kind of figure out what we might need to pay down, what we might need to do. If someone has a lack of credit, maybe they need to open a new account, things like that. So there's things that I can navigate that way to kind of help improve someone's score. If somebody's score is kind of beyond of my skill set and what I can come up with, then I would obviously at that point refer them out to an expert. And I do have people that I work with and I trust that have successfully helped borrowers of mine get into a better credit position and qualify. So, I've worked with people for 6 months to a year. It just kind of depends on what they kind of need to improve. But certainly that is an option.
That's great. And so not too long ago, I had somebody come to me and ask for help with a rental. She had 2 dogs and she was looking for a rental at $1,600 a month. And I asked her, why don't you buy? And she was like, there's no way. I don't have money for a down payment. I don't think that I'd qualify. My credit isn't great. And I said, here, I'm going to put you in touch with a lender. Let's just see what you qualify for, because first of all, it was really hard to find a place that would allow 2 dogs, but the cost that they were charging for, having the dogs was so much higher. It didn't make sense. There was nothing, it was doing nothing for her, no yard, thing looks like that. So what we did was we got her into a USDA loan, which a USDA loan is 100% financing for an agriculturally zoned area. And you'd be surprised what is zoned agricultural. So for example, most of Malta is considered USDA eligible. So there's a map that you can find. You can go online and check it out. But there's a lot of little areas that are not farm and they're not on the extreme outskirts that qualify for 100% financing. So we really do have ways to get creative to get these renters who are paying, even I would say if you're a renter and you're paying $1,000 a month or more, there's a good chance we can get you into a home paying similar or slightly more than what you're already paying for rent. And, with minimal down, 3.5% is not that much when you're thinking about, a house in the low 100s. And then rolling in your closing costs and things like that. But then if you get into USDA and you could do 100% financing, there's a good chance that you're going to the table with zero money out of your pocket.
Yeah, I think there's sometimes that we get scared, and that's why I say, well, it's better renting because I don't have to take care of anything. And if something is not working in my place, I just call the landlord and they will fix it. But I think it's just losing the fear and just go there and get the data, get the information. And if we are not there, we can, people like Ann can walk you through the process to achieve your goal. And it's not that difficult. It's just a little bit of, putting attention, do the paperwork, and but it will have fun on the way. And at the end, you will have your beautiful home. And there, as Jennifer was mentioning, there are many tools that you can use so you can get what you want, and it doesn't have to be that difficult.
Yeah, totally. I agree with that. And I think that, Jen, you might also agree with the fact that sometimes, the answer might be buying a duplex and you live in one and you have the other tenant help pay your mortgage. So that's an option for some folks as well. And the best thing that you can do if you're not sure and you think it might be something that'd be for you, pick up the phone and talk to a mortgage lender, because they can have an initial consultation phone call with you. That's not going to cost you anything, and you can decide whether you want to proceed with an official application or if you just need to get some information fact finding for right now, and then maybe in a couple months you want to have the conversation again. but you don't know what you don't know. So if you pick up the phone and talk to somebody who is an expert, then you're going to be more informed, and education makes all the difference.
And that's a great point about the duplex. A lot of my first-time home buyers who have a very small budget to work with monthly, I'll suggest that they buy the two-family because if you're owner occupying it, it does still qualify for a FHA as long as it's 4 units or less. So we could purchase that with minimal down if it's in that USDA area. USDA doesn't do multifamilies, do they?
No.
I think that's the only, so they won't do
it. I haven't ever done one anyway, so.
They don't qualify. But the FHA loan, the 3% conventional, as long as you are owner occupying, you can still purchase an investment property that you are going to live in with minimal down. And then, like you said, rent, we just talked about the rent prices. The rent prices are so high right now, there's a good chance your entire mortgage plus some will be covered by the other tenant's, income. And sometimes what I find is that we are looking at these homes and the homes, you qualify for more based on the rent. So because doesn't the lender count that as income for that property?
Certain loan programs, yes. And what dictates that in some instances, depending on the program, is whether you already have a housing expense. If you're living rent free and you've never had landlord experience, depending on the loan program, we can't use it. If you have like one where you have a proposed housing expense, rent, something like that, or you own your own home and you're vacating that and selling and moving them into another, then a lot of times we can do what's called offset. So we can give you rental income kind of up to the payment amount to help offset, but not give you positive rental income above that. So it just kind of depends on the program.
And it's interesting because some of these two families where they are, the older homes, especially like in Schenectady and in Troy, the flats are huge. They're 1,400 square foot flats, 3 bedrooms, sometimes 1.5 baths. It's bigger than some of these single family homes that I can put my buyers into. Right. So not only are they getting a larger living space to live in, but they're having the majority of their mortgage paid for. So it's really interesting when people are open to other options. And then down the road, when they outgrow that property, they can actually turn that into a full-blown investment property and purchase a larger home for whatever their needs may be at that point in their life. But I always try to encourage, especially young people, if I could go back and do it again, my first home would have been a 2-family because I would have been that much further into that home at this point versus selling single family to single family, consistently moving up. I would have started my investment portfolio at a much younger age. So that is one thing that I do try to encourage with the younger folks that are out there looking to buy.
Yeah.
But so I think we covered most of our points. Is there anything else that either one of you wanted to add to today's discussion?
I'm not sure. I don't know if we wanted to share specific stories of somebody who thought maybe they couldn't get into a home and then they actually could. Put it in a kind of real world picture for some people. I am actually working with a couple right now. 6 months ago, they didn't qualify. They were still looking for. They're kind of younger. They were looking to kind of upgrade their jobs. They were looking for work in their field that they got degrees in. They had some credit things they needed to work on, and they needed to save some money. They're here 6 months later. Picked up the phone. I was able to pre-qualify them. They went out and they shopped, and they had to do a little bit of shopping. It was a little bit of work, but they're in contract. So it is, more in reach than a lot of folks think that it is. So again, if somebody thinks that it's something they may want, pick up the phone, have a conversation with a mortgage lender, pick up the phone, have a conversation with Jennifer, Anna, and the more you know, the more power you're going to have when it goes into actually shopping and looking for a home.
That's so true.
Well, I wanted to go ahead and thank everybody who tuned in today. Next week, join us Monday morning next week for the Real Estate Chicas Talk Show. And we're going to be talking about sellers and how they can prepare their home for sale in a seller's market versus a buyer's market. Right now, we're in a seller's market, so we'll discuss what the difference will look like. We'll have some people on that can help you look for things in your home specifically, issues, ways to maintain it, and ways to get ready. Most people are looking for their spring market. So tune in next week, 9 a.m. for the Real Estate Chicas Talk Show. I'm Jen Olmstead. Thanks for joining us.
Thank you. And if you have any questions, our phone numbers are below. So feel free to give us a call and we will, we'll answer you. And if you speak Spanish, I'm your people here. You can call me too.
It's really nice to have a bilingual member on our team. You'd be surprised how often somebody does call in who doesn't quite understand English that well. When we're talking about a six-figure transaction, having somebody understand what the process is and making sure that there's not that break in communication is extremely important. So please reach out to us. We'd be happy to make sure we get all of your needs answered. And Anne, thank you for joining us today.
Thank you.
Thank you so much for having me.
She's with Fairway Mortgage. Give her a call if you're thinking about buying, and she will answer your questions and point you in the right direction. So thanks again, and we will see you next Monday, 9 a.m.
Woohoo!
Bye.
Have a great week.
Thank you.